All right. Good afternoon. Appreciate you all taking the time to join me today. Uh, we are in week 4 already, making excellent progress throughout the course. Today, we're going to be talking about completing the accounting cycle. But before we jump into that discussion, I want to talk a little bit about the classroom and about your progress as we are already in week 4. What that means is we're already 25% of the way done with the semester. I know it's hard to fathom that that is where how fast we got along, right? Uh, so quick overview of the classroom and where we are today. We of course have a lot going on in every single week, as you already know. Back in week 1, when you open up week 1 module and you went through the engage and explore. And engage and explore during week 1, you had two things that you had to do. There was a LinkedIn Learning certificate. You opened it up after you linked your profile. We talked about that back in week 1. When you watched all of those videos, you downloaded the PDF version of the certificate and you uploaded it here. And then you had your discussion board, also in week 1. And the other third action item you had during week 1 was the chapter 1 quiz. Okay. In week 2, you had the week 2 discussion board and the chapter 2 quiz. Those were the two action items that you had to do back in week 2. In week 3, you had, last week, the hypothesis annotations. And you had to make 2 original annotations and respond to 2 of your classmates, as it says here in the instructions. Right? And you also had the chapter 3 quiz. So that was the last 3 weeks of this course. Some of you have fallen a little far behind, and I'm getting worried. Okay? And the reason why I'm worried about that is because if you fall too far behind in a class like this, that has a lot of content that we cover in each week, it becomes extremely difficult for you to catch up. Okay? This is a fast moving class. So here's my words of advice to you. If you're one of these individuals that have fallen behind and not submitted those things I just talked about, I need you to get it done. And I need you to get it done very soon. Okay? Quickly. I will still accept your late work. All right? I want you to pass this course. And the only way you could pass this course is by doing the work. That's it. There's no other way to pass the course. It's impossible for you to pass this course if you don't do the work. So please, please, if you are a little late, you fell behind and you missed any of those things over the past 3 weeks, you need to get that done now. Because I promise you, you won't be able to pass if you don't complete all of the work that's due in this course. So that's my soapbox. I apologize, but I wanted to make sure that you all heard the same message. Because honestly, it's the only way that you could pass. And I want you to pass. I do. I want you to pass this course. And the only way that you could do that is to do the work. So please work with me by you doing the work in this course. Okay? I promise you'll be all right. You just got to dedicate the time to do it. Ashley, please.
I don't know if this is a good time. It says late, but I turned it in on time.
Yeah, that hap
For the annotation.
yeah, yeah, don't worry about that part. The annotations because and, thank you for actually for bringing that up. I appreciate you bringing that up. So, when it comes to discussion boards, annotations, and the LinkedIn Learning certificates, those are manually graded. What that means is I have to physically go in and read through everything and make sure that you performed the work according to the instructions, and then I have to manually put in a grade. Okay, so the reason why and Ashley had mentioned this is that it says late, right? They all say late. And the reason for that, Ashley, is because of that manually grading process. I don't put the grade in until after the due date has passed, right? And so that's why it says that in the grade book. So don't worry so much about that. It's okay. But I appreciate you bringing that up. Hopefully that helps to put your mind at ease about that part. So, but thank you, thank you. Okay. Uh, Now here we are in week 4. Week 4 started yesterday and ends on Sunday, right? So week 4, kind of a busy week. It's a short chapter. Yeah. It's a straightforward chapter. Yeah. It's nice and easy. But we have a LinkedIn Learning certificate for you to complete this week. Some of you have already done it. Thank you. It's great to work ahead. It's totally fine if you want to work ahead. I have no problem with that. Everything is open in this course. You can work ahead as much as you want to. It's totally fine. The LinkedIn Learning certificate for this week is pretty long. Okay, I'm not going to exaggerate. It'll take you at least 3 hours to complete. All right. So, my strongest recommendation to you is to start this LinkedIn Learning certificate as early as possible. Just as we did in week 1, the way you want to complete this LinkedIn Learning certificate is you come on down to Engage and Explore. You click on the one that says Financial Accounting Part 1. It'll open up. It'll look like this. And it'll start with this introduction, and then it'll go through all of these short videos. Okay, you want to make sure that this little green check mark appears next to every single one of these, all of them, all the way through. And I mean all the way through, all the way down to the next steps one. You want to make sure that it plays all the way through. It'll take you about 3.5 hours to get through it. Okay, and that's without stopping. All right. So I'm encouraging you to please start that process early. Once you reach the end, okay, and you got all green check marks next to it, you want to make sure that you download the PDF version of the certificate. A screen will pop up at the end, and it'll have options. Add it to your LinkedIn profile, download as a PDF, whatever. You want to make sure you download as a PDF. All right. The LinkedIn Learning certificate, it'll open up like this at the very end. It'll look like this. Okay. You want to select the one that says download PDF only. You click download PDF only, it downloads to your computer. Then you come back to the classroom after you've gotten the PDF. You come right here to where it says Financial Accounting Part 1 Certificate. You click on that, and you're going to upload the PDF as your submission file. All right? You upload that PDF and you submit it, then I get a chance to look at it. And forgive me for picking on you, Makia, because I already see yours here. Makia's got right here, and it's perfect, right? It's got Makia's name on it. It says how long was spent, at what time it was submitted, all that great detail, right? And then because it's a manual process for grading, I come over here and say, yes, this is it. This is what it's supposed to look like. Student's name, how long was it took, the date it was submitted, and I go, great. I come over here and I go 100%, boom, post. You see, it's that simple. All right. So please make sure that you use the class time on Thursday to complete that. Right? That's why you have that additional class time on every Thursday. That's why we only have lectures on Tuesdays. Yeah? Is so you have that additional time to complete this kind of work. So please, please make sure that you do this one and do it on time, because it takes quite a bit of time, yeah, to do it. So I would like to strongly encourage you to work on it and work on it as much as you can. Okay? And then the other action item you have for this week is the Chapter 4 quiz. Any questions on those two things before we jump into the lecture? We're good?
Not
Okay.
yet.
Sometimes you might have technical difficulty, meaning your web browser, like you definitely cannot use Safari. It will not work. Safari will not work with that. So you want to use Chrome or Edge. Chrome or Microsoft Edge. Okay. Now, the other thing you got to make sure is that you clear your cache and you clear your cookies and you enable pop-ups for LinkedIn. Okay? That way it should appear, right? If it doesn't and you still can't get it to work, you need to send me an email right away. Say, Dr. B, I cannot get this to work. We will set up a time for us to meet, okay, on WebEx, and I'll walk you through it. All right, I'll have you show me your screen, and I'll walk you through it. Sound good? I promise I'm here to help you. I know it's a lot of work, but everything we do in this course is designed to help you in the future, especially as you're going into management, you're going to open your own business or whatever the case is. It's designed to help you. So that's why we do it. Okay, thank you so much for hearing my rant. Let's jump into today's conversation on completing the accounting cycle. Now, as always, if you have any questions about the content that we're going to cover, please let me know. You can unmute your microphone and ask your question. You can type your question into the chat, and I'll respond accordingly, right? So please ask questions along the way. Yeah. Okay. So over the past 3 weeks, we've been building on this concept called accounting. Accounting, as you know, is the language of business. And that language is how we communicate transactions that have occurred in the business in a meaningful way. We do that by creating the financial statements. The financial statements are built on those transactions, right? Those transactions build the financial statements. The income statement represents all of your revenue, sales, and all of your expenses. And at the end, we have net income. The balance sheet represents all of the company's assets. That's what the company owns. It also represents the company's liabilities. That's what the company owes to someone else. and it includes the company's equity. That's what the owners own. You see, that's the accounting equation. Assets equals liabilities plus equity. That's why it's on the balance sheet. The balance sheet shows the updated balances of all of those accounts. Okay. Then we have the statement of owner's equity. This is also known as the statement of stockholder equity. This is the area that shows the changes in equity. What I mean by that is we take the net income from the income statement plus any contributions that the owners have made minus any withdrawals that the owner took to get to the ending balance of equity. That ending balance of equity shows up on the balance sheet. Okay, you see how they're connected. That's the way that those statements are connected. And then the last financial statement that is built from all those transactions is called the statement of cash flows. And the statement of cash flows represents the cash coming into and out of the business for operating activities, that's the day-to-day operations of the business. Financing activities, that's the purchase or sale of property, plant, and equipment. And I'm sorry, that was investing activities. And then financing activities, as the name implies, that's like paying back a loan, taking out a loan, issuing stocks and bonds, that kinds of thing. So operating, investing, and financing activities on the statement of cash flows. All of those financial statements are built based off of the transactions that have happened, right? And as we've completed building those financial statements, we go through what's called the closing process. And we close out the temporary accounts. And we start again, fresh. Except for, of course, the balance sheet and the statement of cash flows, because those are permanent accounts. The balances are always going to be there, but they're not going to be on the income statement in the next month. What I mean by that is, for example, right now we're at the end of January 2024. Tomorrow's the last day of the month, right? So on Thursday morning, my income statement is going to be zero. I'm not going to have anything on my income statement on February 1st. The reason for that is because the income statement has revenues and expenses. Those are what we call temporary accounts. They get closed out through net income, right? We close out those accounts because we can't go into the next accounting period, the next month, with balances on an income statement. Because the income statement represents a period of time, which is usually a month. That's an accounting period of time. So I'm going to talk about those things today. So over the past 3 weeks, we've been going through that accounting cycle, like I said. We learned how to build the financial statements. We talked a lot about that last week. Now, here we are. We have come to a point where it's time to close out the income statement and update our balances accordingly on our balance sheet and statement of cash flows. There is this thing called a worksheet. Think of it like an Excel worksheet. It's designed to help us in preparing the financial statements. It shows me things that may be missing, because I use the worksheet as the way to look at the difference between what's in my accounting system, like QuickBooks, and what's on my my bank statement. The two usually never match. The reason is because the bank charges fees, checks don't always get cashed on time, uh, those kinds of things, right? Maybe a bounced check, so I get non-sufficient funds, whatever. But they don't always match. And so I need to make them match. I need to update my accounting information system, my QuickBooks. And I use a worksheet to help me do that. So here are the benefits of using such a worksheet. Again, the worksheets are not required. It's not a required step in the accounting process, but it helps. It helps a lot. It helps to reduce the risk of error, prepare the financial statements. It shows the effect of proposed transactions, kind of like the what if scenario. It also helps me to identify the links of accounts and make adjustments to the financial statements. That part right there, the one I just said, that's where those bank fees, interest earned from the bank account, uh, and then any other type of like non-cash checks, that's where that shows up. Yeah. So it helps me to link and make those adjustments. So that's why we use worksheets. That's why I personally use a worksheet. I'm going to show you an example here in a moment. But before we get to that, these are the 5 steps that we use in order to create such a worksheet. The first step is to enter the unadjusted trial balance. As we talked about last week, the unadjusted trial balance represents the balances of all of your accounts unadjusted, meaning before the adjusting entries have been made. The second step, and this goes in the second 2 columns, is called entering adjustments. These are the adjusting entries. Remember last week we talked a lot about adjusting entries. And we talked about how those adjusting entries impact the balances of those accounts, right? We talked about when we looked at the thing called the adjusted trial balance, which leads us to the third step, which is have 2 columns for the adjusted trial balance. Now, as you recall from our discussion last week, the adjusted trial balance shows us the balances of all of our accounts after we made the adjusting entries. So we take, in other words, what we take is the unadjusted trial balance plus or minus the adjusted amounts equals the adjusted trial balance amount. You see? So those are the 3 primary steps. And then the 4th step is we sort the adjusted trial balance amounts to the financial statements. In other words, we match those to the income statement, balance sheet, statement of cash flows. And then the 5th step, of course, is we take the total statement columns and we compute the what we call net income. That's the income or loss. And the balance columns. That part sounds complicated. It's not. I'm going to show you exactly what that looks like. So here we have the worksheet, right? So those 5 steps, right? The first step, the unadjusted trial balance. Second step, the adjusting entries. Third step, the adjusted trial balance based off of the adjusting entries. The 4th step is we match our income statement, balance sheet, statement of cash flows, statement of owner's equity. We match the respective accounts to those financial statements. And the 5th step is we close everything out through net income, you see. So those are the steps to creating a worksheet. Again, the worksheet's not required. It's not something that gets filed anywhere. It is used by the company internally to help us to again identify those differences. You see? So that's the whole point behind a worksheet. That might be one or two questions on your quiz, just so you know. It'll ask about the worksheet. Okay, now that we know about the worksheet, what it is, how it works, I want to talk about, and this is probably the most important part of this chapter, what we call the closing process. As I had mentioned earlier, the accounts on the income statement are what we call temporary accounts. At the end of each accounting period, end of each month, for example, tomorrow, January 31st, I need to start closing out my accounts. So after I close the business for the day, I'm going to start closing out my temporary accounts. It's a process, right? Because on February 1st, on Thursday, I got to make sure that my income statement is zeroed out, right? Because I can't start the next accounting period with sales and expenses. They haven't happened yet. Remember, we have to follow the matching principle. The matching principle, the expense and revenue recognition principles, we have to adhere to those things. And the way to do that, of course, is through, part of the way to do that is through the closing process. Sorry, close out my temporary accounts. I'm going to show you what all that looks like. So, the closing process. We need to reset our revenue and expenses on our income statement back to zero. We do that at the end of every single month because I can't start a brand new month with sales or expenses because they haven't happened yet. You see? So I need to zero them. So that's the first step of the process. I identify the accounts that I need to close. Right? First step of the process. And those are what we call my temporary accounts. Then I need to record and post what we call closing entries. The closing entries are journal entries, kind of like adjusting journal entries, that I make at the end of each month. They help me to close out my temporary accounts. The way that I do something like that is I would debit an account called Income Summary. Income Summary is a temporary account that I only use for closing out temporary accounts. I debit an account called Income Summary, and then I credit all of my expense accounts. When you credit an expense account, you're reducing that balance. Where basically what that process does, or what that type of entry does, is it takes all of the expenses and it moves it into a temporary account called Income Summary. I follow the same process for all of my revenue. What I do is I debit my revenue accounts and I credit Income Summary. What that does is I'm moving all of my revenue accounts to Income Summary. Once that's done, I take the balance of Income Summary and I either debit or credit based off of the balance. I put that into my equity account, right? And that's how we move it off of the income statement and onto the statement of owner's equity. I'll walk you through the process, but I just want you to understand what recording and posting closing entries is. Okay, it's a way to zero out those temporary accounts. And then, of course, the last part of the process is to prepare the post closing trial balance. Post closing trial balance. Again, with a trial balance, we're making sure that everything balances out. Basically, it's a way of verifying that all of my temporary accounts are zeroed out before the start of the new accounting period. Okay, so that's the closing process. As I had mentioned, the income statement has all temporary accounts, revenue and expenses. We close out those temporary accounts to income summary. We close out income summary to our owner's capital. Yep. Statement of owner's equity. Withdrawals is also a temporary account. As you know, withdrawals lives on the statement of owner's equity. It's a temporary account because after net income, we take out the withdrawals, if there are any, and that moves to the ending balance of owner's equity. You see, so that's why it's called a temporary account. So those are our temporary accounts. Everything else is considered to be a permanent account. These are all of the accounts on the balance sheet. All of your asset accounts like cash, accounts receivable, inventory, property, plant, and equipment. Those are all permanent accounts. They don't go anywhere. We don't zero out cash at the end of every month. That'd be silly. The bank account's still there. It's still got a balance as it moves through the accounting periods. Right? So all of your asset accounts, they'll always have balances on them. You see, that's why they're a permanent account. The same is true for liability accounts. I still got to pay my employees' wages, so wages payable still going to be there. Accounts payable, I still owe bills regardless of what month I'm in. Accounts payable still going to have a balance. My long-term liabilities like notes payable, the loan's still there. You see? So assets and liabilities are always going to be permanent accounts because they're always going to have a balance in them. We don't close out permanent accounts. We just carry that balance forward into the future. The same with owner's equity, capital, whatever you want to call it. Owner's equity is a permanent account. The owner made contributions into the business to get it started. The owner sometimes takes cash out too, right? The balance is always going to be there. So owner's equity or owner's capital is always going to be there, you see. So assets, liabilities, and equity, those are permanent accounts. They don't go anywhere. We only close out the temporary accounts. Now, how do we close out the temporary accounts? There's a process. And I had mentioned this a little bit ago. I had said, we got to close out our revenue, our expenses, owner's withdrawals. We got to close out those temporary accounts. How do we do that? We use another temporary account called income summary. You see, the income summary then gets allocated to owner's equity or owner's capital. So first I close out my revenue accounts. I debit my revenue accounts and I credit income summary. So whatever my revenue balance is, I debit that and I credit income summary. That moves out all of my revenue into income summary to close out my revenue accounts. For the expenses, I debit income summary and I credit all of my expenses. What that does is it takes the expense balances and moves them into income summary. Once I have all my revenue and expenses in my income summary account, I close out the income summary account by debiting or crediting based off of the balance to owner's equity or owner's capital. You see, that's the process. That's the process. I'm going to show you a visual of what that looks like. So step one, close out my revenue accounts, the income summary, which is, I debit the revenue, credit income summary. I close out my expenses by debiting income summary, crediting all the expenses. And then you see here we have the balance based off of the debits and credits. The balance is on the credit side, as it should be, because hopefully, hopefully your revenue is greater than your expenses. That means you made an income. Yep. So here we have the balance, 3,785. And so we take that balance and we close it out to our owner's equity, owner's capital. Minus any withdrawals gives us the ending balance, owner's capital. You see? That's how we close out our temporary accounts. Any questions on that? That can be somewhat confusing sometimes. So I just want to make sure you're clear on how that process works. The great news is, because we are in a modern world with these things called applications, like QuickBooks or Oracle, Sage 50, you name it, right? There's a lot of accounting softwares out there. Accounting software does this process for you, right? It's just up to you to know how it works, right? You need to know how it works. Even as a business owner or whatever it is that you're going to do, management, whatever, you need to know it. You need to know how it works. Okay, so that's the closing process. After we complete the closing process, we need to complete what's called the post-closing trial balance. What this does is it helps me to verify that my total debits of all of my permanent accounts equal all of my total credits of my permanent accounts. You see, I'm making sure that my debits equal my credits. That's how we balance it out. That's why we call it a trial balance. See? It basically validates that all of our temporary accounts have a zero, before we start the next month. Here's what it looks like. Here I have listed out all of my permanent accounts. All of my assets, of course, they have debit balances. And all of my liabilities and equity, they have credit balances, you see? So as long as my assets equals my liability plus equity accounts, the debit total, in this example, 43,045, equals the credit total, 43,045. See, it represents the accounting equation, and it shows that it is always in balance. Assets equals liabilities plus equity. That is the accounting equation. Asset accounts always hold a debit balance. Liabilities and equity accounts always hold a credit balance. So therefore you see, assets always equals liabilities plus equity. So that's the post-closing trial balance. after we've completed that, I'll show you, and this because this is the last step of the accounting cycle. I want to show you everything that we went through over the past 3 weeks, past 4 weeks now, right? The first thing you learned how to do, and this was on day one of this class, was to analyze transactions. Remember, and I know that a lot of you remember because we went way over time that day. I remember that day. We went through, I don't know, I think it was like 12 or 13 transactions, right? I showed you exactly what the transactions were, how it impacted the accounting equation. So step one is we went through the analyzing transactions. Then I showed you, I think it was the same day, how to journalize the transactions. What was debited, what was credited, right? We call that double entry accounting because I'm impacting two accounts, right? And then I showed you how to post it to the general ledger. So steps 1, 2, and 3 of the accounting cycle we talked about back in day one of this class, week 1. In week 2, we went through several more of these processes, right? We went through steps 4 and 5. I showed you back in week 2 how to prepare an unadjusted trial balance. That's a list of all of the accounts and their respective balances. Then in step 5, also in week 2, we did some adjusting entries. And I showed you how to post those to their respective accounts. Remember? The adjusting entries are things that we do at the end of each month to make sure that our balances are accurate. Then in week 3, which was last week, I showed you how to do steps 6 and 7 of the accounting cycle. Step 6 was we prepared what's called the adjusted trial balance. The adjusted trial balance showed us the unadjusted balances plus or minus the adjusted amounts from the adjusting entries equals the adjusted amounts, right? That's the adjusted trial balance. That was step 6. We talked about that last week. Step 7, we also talked about last week, which is preparing the financial statements. The income statement, balance sheet, statement of cash flows, statement of retained earnings, also known as the statement of owner's equity. We prepared those financial statements. And how do we do that? We did it based off of the adjusted trial balance. Right? We went through that process last week. And then just now, in today's lecture, I showed you how to close the temporary accounts through the closing process. And I showed you how to prepare the post-closing trial balance. So at this point, we've completed the accounting cycle. We do this cycle every single month. Every single month. Step 1 of the cycle is continuous. So we're always entering transactions, analyzing, journalizing, posting them. We do that all the time. Okay? At the end of the month, I do my unadjusted trial balance, adjusting entries, prepare the adjusted trial balance, prepare the financial statements, close out the temporary accounts, and prepare the post-closing trial balance. I do basically steps 4 through 9 at the end of each month. Steps 1, 2, and 3 I'm doing throughout the month, you see. And hi, I see your hand. What's going on?
So if you were to work as an accountant, what do they do like on the day to day?
Steps 1 through 3 of the accounting cycle is the day to day. So as an accountant, I could tell you from my experience, Ty. Okay, so uh, when I first started out owning my own business, I had to learn how to record transactions, right, using QuickBooks. And so what I did was, uh, for every sale that I made, I would debit either cash or accounts receivable, however the customer was paying me, and I would credit sales, right? What
Mm.
that's doing is I'm entering my sales that I made for that day. Um, and I do that at the end of every day. And then what I would do, Ty, is as I would get bills in, like the rent, the electric, the uh, invoices from my vendors for the inventory, I would enter those into my QuickBooks, right? So what I'm doing in that process is I'm analyzing the transactions, journalizing them by entering them into the QuickBooks, posting them to the general ledger by validating them. That is something I did every single day. So you, and then of course, paying the bills and paying your employees and all of those things, so that's all the day to day operations. It sounds kind of boring, a little bit from the day to day side of things, but then at the end of the month, you're busy because you got to prepare the unadjusted trial balance, do the adjusting entries, prepare the adjusted trial balance, prepare the financial statements, close out the temporary accounts, and prepare the closing trial balance. So all of those steps tie at the end of every month I had to go through, and that was kind of a pain, to be honest, because it's a lot. It's a lot. I mean, here you are at working at midnight, basically at the end of every single month, and you're doing this to make sure that you don't go into the next month unprepared. And so that was my day to day, and that was just in my business. And then after I had sold that business and started working as a financial controller for a hotel company, is there was a lot of volume. And what I mean by that is every day out stacks of bills, stacks and stacks of checks that had to go out. You know, the revenue that was kind of automatic. I would look at the receipts from the previous day's sales and enter that in. No problem. That's easy. That's a simple journal entry. But the rest of it, you got stacks of bills from vendors, from utilities, from whoever. That takes a lot of time. So it depends. So what I'm trying to say here, Ty, is that it depends on the volume of the business. If we're talking like, a conglomerate type of business, like Fortune 500 style or whatever, big company, you're going to see a lot of action every day. But if we're
Yeah.
talking like a local ma and pa type of shop, like a super local place, one owner, two owners, whatever, it won't be as busy.
Right.
So that kind of gives you an idea of the day to day, so to
Me
speak.
does. And thank you.
Cool. Yeah, absolutely. Yeah, great question. Okay, so that's the accounting cycle. Now that you know about the accounting cycle and that you've already experienced it over the past 4 weeks, now I want to talk to you about one of the last steps that we do, last things that we prepare, I should say. It's called the classified balance sheet. The balance sheet has assets, liabilities, and equity accounts. You already know that. We've been talking about that for a minute now. It represents all of the accounts on the balance sheet that come from the accounting equation: assets, liabilities, and equity. What you might not know about the balance sheet is that we like to classify those accounts. Okay? What I mean by that is we break them up based off of the characteristics of those accounts. We break them up into what we call current or long-term, also known as non-current, current or long-term. Okay? Here's what I mean by that. The word current in accounting means 12 months or less. Current in accounting means 12 months or less. I expect to use my cash within 12 months or less. I expect to collect my accounts receivable from my customers in 12 months or less. I expect to sell through my inventory in 12 months or less. I expect to use my prepaid insurance in 12 months or less. Those are all current asset accounts that I just described to you. We call them current assets because we expect to use those assets in 12 months or less. That's why they're called current assets. Then we have these ones called long-term assets. We also call these long-term assets fixed assets or plant assets, or I keep going. They're long-term assets. What I mean by that is we use these assets for longer than 1 year. Okay? They're called long-term assets or non-current assets, whichever you prefer. They both mean the same thing. Okay. Non-current assets include things like property, plant, and equipment. My building, my land, my equipment, I'm going to use that stuff for longer than a year. That's why it's long term. We call it fixed. It ain't going nowhere. Okay. That's plant assets. We also have what's called, some businesses also have what's called long-term investments. Long-term investments represent things like stocks and bonds that the business holds on to for greater than 1 year. Okay. It also long-term investments can also represent things like property, plant, and equipment that the business purchased but is not using. They're going to sell it at some point in the future. An example of that would be a factory looks to expand by purchasing the land next door, but they don't have any intention of expanding anytime soon. So they'll hold that land as an investment into the future, you see. Call those long-term investments. And then we also have what's called intangible assets. The word intangible means that I cannot physically touch it. I cannot physically touch an idea. I cannot physically touch a patent. I cannot physically touch a copyright. These are all what we call intangible assets. For those of you who might be in the music business, for example, the records, the rights to the music, those are intangible assets. You can't physically touch music. Well, I mean, kind of, but you can't, right? So we call those intangible assets. Now on the liability side. We classify liabilities as either being current liabilities or long-term liabilities. Okay? Current liabilities are liabilities that I expect to pay within 12 months or less. Remember, current 12 months or less. Current liabilities are liabilities I expect to pay within 12 months or less. This would include things like accounts payable. Those are the bills I collected, haven't paid them yet. Wages payable. I got to pay my employees on a regular basis. Wages payable. Unearned revenue. I expect to convert that into revenue within 12 months or less. Taxes payable. I got to pay my taxes within 12 months or less. You see? We call these current liabilities. They're liabilities that we expect to pay within 12 months or less. We also have what's called long-term liabilities, also known as non-current. These include things that are long-term, like a mortgage payable. That's long-term loan, yeah? We pay that for longer than 1 year. We also have what's called notes payable. That's the business took out a loan from the bank and it's greater than 1 year. You see, those are long-term liabilities. Other ones might include things like a pension liability. That's also long-term. 401k liability, long-term. And then equity. Equity is just equity. It's just equity. So you see, on a classified balance sheet, we call it classified because we're classifying assets and liabilities into both current and long-term. This is what a classified balance sheet looks like. You see that it's broken out. Current assets and then long-term assets. Under liabilities, we've got current liabilities and long-term liabilities. And then we just get equity. But it's just as I had described just a little bit ago. Again, remember the word current. Current means we expect to use it within 1 year or less. Okay? Examples of current assets include cash, short-term investments, accounts receivable, short-term notes receivable, merchandise inventory, prepaid expenses. We expect to use these assets or collect these assets within 1 year or less. On the long-term side, we have what's called long-term investments. These would include things like long-term notes receivable, investments in stocks and bonds held for more than a year, etc. Property, plant, and equipment's up next. Property, plant, and equipment. We use these fixed assets called property, plant, and equipment for greater than 1 year. Remember, the reason why property, plant, and equipment is an asset to the business is because I use these assets to help the business to generate sales. That's why we call them assets. And then some businesses have intangible assets. Cannot physically touch them. They're long-term. They include things like patents, trademarks, copyrights, franchises, and this one concept called goodwill. You might be wondering, Dr. B, what in the heck is goodwill? Goodwill is when one company acquires, through mergers and acquisitions, another company that has assets that hold value above its paid price. We call that goodwill. Just so you know, some of you are probably curious. On the liability side, we have the current liabilities and long-term. Current liabilities, as I mentioned, are liabilities that we expect to pay within 1 year or less. Classic examples include accounts payable, wages payable, taxes payable, interest payable, and unearned revenue. It will become earned because we're going to provide the good of the service eventually and turn it into revenue within 1 year or less. Then, of course, we have long-term liabilities. These are liabilities that we're going to pay on greater than 1 year. Examples would include things like notes payable, mortgage payable, bonds payable, and lease obligations. A lease obligation, you might be wondering, is when a business leases something for greater than 1 year. This could include things like a long-term lease on a building, a long-term lease on a piece of equipment. Yeah, a lease is where the business doesn't actually own it, but they have to make long-term payments, you see. It gets a little complex. I just want to let you know what they were. And then, of course, we have equity. Equity is just equity. It's what the owners own. Yeah. It's not separated into current or long term. Equity is not separated into current or long term. It's just simply equity. Okay. Any questions about any of that stuff? We're okay so far, yeah? We're almost done. Okay. Ratios. You knew I was going to get to ratios. You knew that. You said, Dr. B, I love ratios. You give them to us every class. They're my favorite. Said no one ever. Okay. But there's usefulness to ratios. One of my favorite ratios is called the current ratio. I love this ratio, and here's why. This ratio tells me if the company has the ability to pay its current debt. Can the company pay its current bills? That's a great question to ask, especially before you decide to invest in a company and before you decide to become a partner in a business, or even before you decide to work for that company. I want you to calculate the current ratio. Why? Why would you work for a company that can't pay its current bills? You wouldn't. You want to make sure it has the ability to. So calculate the current ratio. Right? Here's how you do it. You take the current assets found on the classified balance sheet divided by the current liabilities found on the classified balance sheet. That gives you the current ratio. This shouldn't come as a shock, but anything greater than 1 is good. Anything greater than 1 is good. Anything less than 1 is risky. Okay, that's scary if it's below 1. It's good if it's above 1. You see? Okay, sometimes in accounting, we make mistakes. It happens. Okay, accountants aren't perfect. We're not robots. Right? So sometimes we make mistakes as accountants. So we do what's called a reversing entry. Reversing entries are very simple to do. They're very similar to how you would do an adjusting entry. The only difference here is we're just reversing what we had, the entry that we made. That's it. It's pretty easy to do. It's a way to correct your mistake. Yeah, as an accountant. So, a couple of examples of why these might happen. Salaries expense. Oh, I almost paid my employee too much. That happens, right? So you just reverse it. It's really that easy. Okay. Instead, because salary expense, debit salary expense, credit salaries payable. Then you realize, oh, that was a mistake. I didn't mean to do that. Make a reversing entry. All you're doing is reversing it. You debit salaries payable, credit salaries expense. Right? Reversing entry. You're just reversing it. It makes your life easier if you make a mistake. Yeah, it's a way to clean it up without making it look too ridiculous. You know what I mean? So, we made it to the end of today's conversation on completing the accounting cycle. Are there any questions they have about completing the accounting cycle before I talk about to recap what you need to do for this week?
Professor, I have a question.
Yeah, go for it. Who's that?
Harlan.
Oh, Harlan. Hey, what's going on?
Yeah. So, in regards to what we've covered so far, are we expected to know how to complete the accounting cycle to perfection, or
I wouldn't say to perfection. I mean, the accounting is a practice. It's just like being a lawyer. A lawyer is a practice. The reason why they call it a law practice is because they practice law. You know what I'm saying? But the same thing applies to accounting. You're not going to be an expert at this in 4 weeks. Heck, you're not going to be an expert in this in 15 weeks. But you're going to know a hell of a lot about it. Okay? I'm not expecting you to perfect this. No way. Nobody does. That's why we practice it. Accounting is a practice, just like law is. So, what I mean by that, Marlon, is that over the past 4 weeks, we learned everything about the accounting cycle, right? So I would expect you to know about it. I would expect you to know how to implement it. I'd expect you to know how to use it. But I really don't expect you to be an expert at it because nobody is. I mean, you know, it's just. But yeah, I mean, you should be able to not necessarily master it, but I definitely want you to know about it. And the way you're going to master it, Marlon, is is so this week, as you know, we have our next da 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 LinkedIn Learning Certificate. This LinkedIn Learning Certificate is super important. The reason why that is because this particular LinkedIn Learning Certificate goes through basically everything you learned about over the past 4 weeks. Okay. What this does is it reinforces what you have learned already. Now, you'll get down to it. You're going to notice, yeah, Dr. B is all videos. There's no quizzes. There's a couple things that I want you to take away from this. Especially if you're super interested in becoming an accountant or you want to learn just a little bit more about it. There's this one called Exercise Files when you come in here, okay? You can download this. It's a series, and I'm pretty sure it's just Excel files, but it's a really cool way. I don't know what's happening here. It's a really cool way for you to kind of learn a little bit more about it, and so something to think about, yeah. But to your point, Marlon, no, I'm not expecting you to master it, but I definitely think you should be pretty damn good at it. After what you've learned for the past 4 weeks. Hopefully that helps to answer your question.
I have a question regarding the adjusted trial balance.
Yeah, go for it.
Um, so in regards to the accounting cycle, parts 1 through 3, analyzing the transactions, making journal entries,
Yep.
and posting them, I mastered. Like I got that part. The adjusting part, um, I I understand how to do it.
hmm
Actually doing it, I couldn't really grasp it when I tried to do it in Excel.
Yeah, sure. That's in Excel it makes it a little harder to be honest. And the reason why I say that is because Excel doesn't. It's not fully connected with a true. How do I want to put this nicely? In a true fashion. What I mean by that is when you're making the entries, right? You're debiting, we'll say, um, unearned revenue, and you're crediting revenue, right? That's one of the adjusting entries we would make to recognize that we're earning that unearned revenue, right? Now, when you make that entry, if you do something like that in Excel, it's not really updating any balances because there's no connectiveness in Excel, and at least in that way. You know what I'm saying? So
I understand.
so, but what you need to know, Marlon, is that when you come to the adjusted trial balance, that's when you'll notice. Let me see if I can pull that part up. That's when you'll notice. And where's that slide? Just a sec. The worksheet. I like the worksheet a lot for this reason. So the adjusted trial balance part is here, step 3. So on the worksheet. So you'll notice that what we're doing, for example, on the supplies. So on supplies, our unadjusted trial balance was $9,720. We had an adjusting entry that we made. It was the second entry, letter B, that we made. Those letters, by the way, Marlon, this come from last week. Yep. Because remember, everything builds on itself. So last week, we made an adjusting entry that involved what appears to be the use or consumption of supplies. Okay. And so what we did here is we recognize the consumption of supplies to that adjusting entry, and then we go through the adjusted trial balance. The adjusted trial balance is quite simply the adjusted balance of that account. Now, because we used $1,050 worth of supplies from that entry, we take the unadjusted amount, $9,720, minus $1,050 from the adjusting entry, giving us the adjusted trial balance of $8,670 for supplies. See, and so that's kind of like a in practice way. Yep.
Copy. So do you expect us to be able to produce this worksheet or?
No. All I want you to do is know how it works. I'm not
Oh,
going to
okay.
expect you to produce these kinds of things. Because remember, Marlon, the reason why we have these Excel exercises in each week, they're just exercises. They're literally there just to help you to practice. Those don't get submitted for grading. But they're there to help you to have a deeper hands-on learning experience and understanding how it works. That's all.
Copy. So I know that this is Principles of Accounting 1. And what accounting class do we actually start producing, documents, financial statements?
That's a good question. So in this course, that's kind of what you're learning to do, right? And so that's kind of what you did over those past 4 weeks, is you learned how to put those together. Ultimately, as we move forward through this course, you won't be necessarily building them on your own, but you'll be learning more in detail how those work, especially through the exercises. But you won't be necessarily building them because this isn't a course on what we would call there's a course for it. It's called Accounting Information Systems. And those types of courses, you'd be building those in QuickBooks or in whatever software. When you get to Principles of Accounting 2, especially if you take it with me, I have entire parts of that course built in with QuickBooks. And so you'll be using QuickBooks in that course.
Okay.
Yeah.
Thank you.
Great
That answers
question.
this
Great
question.
question. Yeah, absolutely. My pleasure. Great. Okay, so again, just to recap what's due by Sunday night, and I want you to use the class time on Thursday, is to complete the LinkedIn Learning Certificate. You'll come right here into the week and open it up from there. You'll go through a series of videos. It'll establish a green check mark next to all of them. At the end, when you reach the very end, and we're talking all the way to the end after next steps, you'll receive a certificate. It'll pop up. Make sure your pop-up window is enabled. It'll look like this. You're going to want to click on the one that says LinkedIn Learning Certificate. It'll look something like this. You want to click on the one that says Download PDF Only. It'll download to your computer. You'll come back to the classroom and you'll upload it here. Okay? And then, of course, the other thing I need you to do is take care of that Chapter 4 quiz. Those are your 2 action items for the week. Questions on that? We good?
No discussion for the week?
No discussion for this week. Just the certificate and Chapter 4 quiz. Okay, awesome. Thank you all so much again for your time today. I sincerely appreciate your effort. I know that it's a lot of stuff that we do in this course, and it does not go unnoticed. So thank you so much. I really do appreciate all of you and all of your efforts that you're making. If you ever need any help of any sort, I want you to reach out to me. You can call me, email me, set up office hours. Whatever you need, I'm always here for you, and I want you to know that, okay? Thank you all so much. If you have any late work, make sure you get that done as well, okay? Very, very important that you get caught up. Thank you again. Appreciate all of you. Have a wonderful rest of your night. Take care. Thank you so much. Bye-bye.
You do the same.
Thank you. Thank you.